Well, basically, we think that central banks are excessively concerned with inflation. We don't believe in inflation persistent. We see no reason to think that inflation will persist at current levels. And actually, energy-based effects will imply that inflation will come down over the coming months. So we see, deflation risks as remote for the time being, but we think that that could be a theme for the end of next year. And actually, it's not really a concern, it's more an opportunity for equity markets, because if deflation fears come back, that will push higher equity valuations. And this will be quite positive for equity markets. Actually, equity markets tend to perform well historically when inflation is low and below central bank targets. This is the configuration that we had over the last decade that was very bullish for stocks. And 2022 marks an interruption in this cycle, but we don't think that we are here for a persistent inflation. We see central banks excessively concerned, as I said, but in our view, the Fed is aware of the risk of over-tightening, while the ECB is much more rigid, obstinate with the 2% rule, and the ECB actually risks causing a severe deceleration in economic activity in the euro area.
I'm going to unpack that ECB story a little bit. Just want to focus a little bit more on the equity front then. A bit of a bullish picture is what you're pretty much painting here, Philippe. Is that really the case for what you're seeing heading into next year?
Well, we think that the pieces of the disinflation puzzle are gradually falling into place. We think it will take time before the markets get confidence or a clear picture about the central bank intentions. That, central banks were again somewhat aggressive in December, causing the reversal recently. But we are more constructive on equities than the consensus. We are more constructive on equities than we were a few months ago. We see the strong resilience in corporate earnings and as well consumer spending as a tailwind for corporate profitability. So we are somewhat more constructive than the consensus, and also compared to where we were a few months ago, we are seeing the signs of disinflation on several fronts, and we think it will continue. So this means that central banks will probably not need to cause a major recession. We think that central banks will have room to kind of change the stance over the course of 23. And we think that we have an 8-10% upside for equity markets in Europe and the US over the next 12 months.
Yep. Banks seemingly headed slightly higher than today. But with recessions then looming, the resilience of this banking sector to be tested quite heavily, you think?
Well, for sure, banks, remain valued as they were in the old world of deflation and accommodative monetary policy. So we think that banks should be supported by the normalization of monetary policy. Their valuation remains quite attractive. Their profitability is much higher with higher interest rates. And for sure, there is a risk if we have a severe recession, the asset quality of commercial banks will be impacted negatively. But we don't think we'll have a severe recession. So that's the reason why we are constructive on European banks in particular, French banks also in particular, and a bit less on Spanish banks. But we are overall overweight on the banking sector, assuming that their profitability will remain high and that we won't have a severe recession that will, depress their asset quality.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.